In the prior video, we introduced the impact of an acquisition on the target's balance sheet. Up until now, the discussion has been about the GAAP-based balance sheet. But companies prepare two sets of books. One is in accordance with GAAP, generally accepted accounting principles, both either US GAAP or IFRS. And the other with according to tax rules. In other words, the financial statements that are submitted to in the United States to the IRS follow similar but somewhat different accounting rules than the accounting rules that are used for GAAP purposes. So depending on how a deal is structured, there can be a major difference between the carrying values of assets as they are accounted for book purposes versus tax purposes. And broadly speaking, we've laid out a table that identifies the major themes or the major paradigm in M&A, which is, from a book perspective, it's what we've been talking about now. Basically, it doesn't really matter legally how the transaction is structured. Any sort of legal structure of a deal is basically accounted for with this write-up to fair market value that we talked about in the prior video. The book values of assets, we call that the book bases, both of assets and the liabilities, get written up or down to fair market value. Nothing new there based on what we've been talking about. This just represents the book financials, the ones that we as investors and as bankers have access to through the SEC, etc. The tax returns, which are not made public to us, the way that the IRS in the United States sort of accounts for the carrying values of assets actually depends on the legal structure of the transaction. Specifically, if a deal is structured legally as a stock sale, there is no change for tax purposes in the tax return balance sheet. There's no change in basis for the assets or liabilities. They don't get stepped up. The easiest way to think about it is from a tax perspective, it's as if no acquisition has really taken place that merits the revaluation of the assets. If the deal is structured, however, for legal purposes as an asset sale or what's called a 338 H10 election, which is basically like an asset sale. It's actually a stock sale that for tax purposes is treated as an asset sale. We spent a little bit of time talking about that towards the end of the course. But basically, when we talk about asset sales, we actually really talk about asset sales / 338s. It just so happens that because it's easier to implement using this construct, to actually affect the deal in this construct, most asset sales are actually stock sales that are deemed asset sales under 338. You don't really need to know the difference at this point, other than an asset sale is basically like a 338 election for accounting purposes. And so when a deal is structured as an asset sale legally or 338, just like for book purposes, the assets are stepped up to fair market value. And just some jargon so you understand, when we talk about book purposes, assets get written up. When we talk about tax purposes, they get stepped up. It means the same thing, but when you're talking about tax returns, it's called a step up. When you're talking about books, it's called a write up. So what you need to keep in mind is when a deal is structured as an asset sale / 338, the treatment for tax purposes is basically the same as what we've been talking about. It means there are far fewer headaches for us in modeling. It's not like there are no headaches, but there are fewer headaches. Whereas if a deal is structured as a stock sale for book purposes, you now potentially have a huge deviation between now the going forward carrying values of the assets for tax purposes and the now usually much higher value for book purposes. So the purpose of this video is to discuss the accounting and real implications of the differences that we just talked about. Keep in mind the following things. The GAAP basis is disclosed, but the tax basis will likely be unknown to you when you're analyzing a deal. What do I mean by that? If the target has provided you their financial statements or they are a public company, they're providing you the GAAP basis financials, the book-based financials. You rarely get access to the company's tax returns. As a result, the assumptions have to be made about what the tax bases might look like. And the framework that we're introducing here provides for just rules of thumb. We're operating with very limited information. So what we're about to talk about as it relates to sort of what the tax balance sheet might look like is really a lot of assumptions and to some extent guesswork. And so we're giving you some general rules of thumb in the typical context of limited information. And this is our sort of disclaimer here. When tax issues are important, you're almost always going to be working alongside qualified tax advisors, and a true complete assessment of tax issues should always be, and in real life are always conducted in consultation with qualified tax advisors. So let's get into it. When deals are structured as asset sales / 338 H10 elections, the target's book and tax balance sheets both get marked up to fair value, with excess getting recorded as goodwill, exactly like for book purposes. The IRS recognizes that an acquisition has taken place, therefore meriting the otherwise not allowed revaluation to fair value. And understand that the acquirer is very happy about this generally, to have a deal structured as an asset sale, because for tax purposes, this revaluation means that you get to record, for tax purposes, higher valued assets like property, plant, and equipment, and intangible assets, which of course lead to higher future depreciation and amortization than you would have had there been no revaluation, like what is the case in a stock sale. And so this higher depreciation and amortization expense going forward reduces taxable income. It reduces the income that you have to pay taxes on, and that creates a very real future tax savings for the acquirer. So the acquirer generally very much favors an asset sale. There's one other thing that we need to be aware of that makes asset sales extremely attractive for acquirers, and that is that unlike book accounting, tax accounting actually allows the goodwill recognized in the acquisition to be amortized. So for tax purposes, you actually amortize goodwill when you recognize it in an asset sale or 338 election. And that often leads to significant additional future tax savings beyond the DNA, incremental DNA. Just a couple of fine points on that. Goodwill is amortized over 15 years for tax purposes, just like all other intangible assets are amortized over 15 years. So this lays the groundwork for acquirers generally very much preferring asset sales. Let's contrast that with when deals are legally structured as stock sales. And just for our purposes now, all else equal, you can structure a deal legally as either a stock sale or an asset sale. To some extent, it ends up being sort of a joint preference by the buyer and the seller. Well, when the deal is structured as a stock sale, the target's book balance sheet gets marked up, but the tax balance sheet does not. So now you have this big deviation for book purposes, what the carrying values are and what the carrying values are for tax purposes. But understand that this is mostly a temporary deviation, because the assets that get written up for book purposes will be depreciated over time, presumably down to zero or whatever the salvage value is. And we assume that the salvage value will be the same for book purposes as it is for tax purposes. So understand that the deviation that's now created, and an easy chart will sort of show this. If you have, let's say you start on the deal date with PP&E of 200, and all of a sudden you write up for book purposes the PP&E to say 500, but for tax purposes you don't get to write it up. And let's keep it real simple. Useful life is over 2 years, so it goes from 500. It goes down to a value of 0 because it's depreciated over 2 years. So you have 1 and 2. Right? This is time. This is number of years. Well, for tax purposes, it also ends up at 0. It's depreciated, let's assume, over 2 years, and it just goes down from 200 to 100 to 0. So this deviation that's created on deal day. This deviation is a temporary one that slowly gets reduced. GAAP accounts for this temporary difference between the book and the tax bases of assets and liabilities via the creation on deal day. The day that this difference is created, it accounts for this difference by the creation of deferred tax assets and liabilities. And we're going to talk about what's created here. Is it a deferred tax asset or liability in a second? But just understand that whenever there's a difference in bases between book and tax bases, under US GAAP and IFRS, you account for it with deferred taxes. There are two major exceptions to this, specifically to the creation of deferred taxes to account for the differences, and those exceptions are land and goodwill. So you do get to write up land and goodwill for book purposes, but in a stock sale you don't get to step them up for tax purposes, but they don't create deferred taxes. And that's because neither land nor goodwill are depreciated or amortized for book purposes. Right? Goodwill, as we just talked about, is actually amortized when it's recognized for tax purposes, but in a stock sale, it's not recognized and therefore is not amortized, creating this difference. So goodwill is recognized for book purposes, not for tax purposes. So you have much higher goodwill for book than you have for tax. Same with land, but those don't generate any deferred taxes because the difference is temporary. And again, a chart will explain. Let's look at land, right? If you have land, say, of 100, and for book purposes it's been written up to 300, well, since land doesn't get depreciated, it just stays at 300 forever. Meanwhile, for tax purposes in a stock sale, it stays at 100 forever. This difference, unlike this one, does not reverse itself. It stays at this place forever, creating no deferred taxes. It's a permanent difference. No deferred tax is recognized. Same with goodwill. Same issue exists with goodwill. We're going to get into examples that sort of highlight this, but just keep in mind, in a stock sale, deferred taxes basically capture these differences for book purposes, with the exception of land and goodwill. So from the acquirer's perspective, an asset sale, at least in terms of the future tax savings, is clearly preferable to a stock sale. Notice that with this stock sale, when you have these differences, there's actually no tax benefit to the acquirer. With the stock sale, even though you get to write up assets and you get the incremental depreciation amortization for book purposes, notice there's nothing actually happening for tax purposes. You don't get the incremental D&A. You don't get the goodwill amortization. So the acquirer generally doesn't like this. There's actually a reason that, surprisingly, stock sales end up making up the majority legal structure in M&A, and that has to do with sort of the target preferences. The target tends to benefit quite a bit from structuring deals as stock sales. But we're going to defer that discussion for a little bit later. The main thing that I'd like you to take away at this point is that asset sales create these tax advantages for acquire. These asset sales create advantages for the acquirer from future tax savings of incremental D&A and goodwill. And they don't create any deferred tax assets or liabilities because there are no real differences created, as opposed to stock sales where there are massive differences that create deferred taxes between the book and the tax bases.